Okay. So Cynthia suggested that as we go into this, it might be good if you go to your speaker view up in the corner and just click on that so that you actually, the person speaking will be bigger on your screen, and then all the other guests will be smaller at the top. So she just suggested we do that.
Might be easier.
Yeah. All right. Eric's joining us. Paul, you made it after all.
Hey, yeah, my conflict resolved itself. So yeah.
Great. There's Mark. Hi, Mark. Hope he can't hear us yet.
Hi, Jeannie.
Hi, Mark.
How are you?
Very good. Got a couple more from the chapter we need to get on because we're going to do a little intro today. All right, I'm going to go ahead and get started anyway, so other people can join us as we go. Listen, I want to welcome you to the July What's Brewing Zoomcast for the Orange County chapter. We first have a little order of business that we want to get through, and that is an introduction of the new officers of NIRI Orange County. So stepping in as chapter president for a second time is me, Jeannie Herbert, head of investor relations at Revance Therapeutics. Moving to treasurer and secretary is Cynthia Skoglund, principal of Skoglund Consulting Group. Cynthia, say hello.
Hi there.
Our past president, David Erickson, is now serving as director and senior advisor. He is vice president of investor relations, corporate communications, and social responsibility at Establishment Laboratory Holdings. So David hasn't come on yet, but congratulations, David. New to our board is a director at large, John Moten. So John's just coming onto the board. He is vice president of investor relations at Foundation Building Materials. So I'm welcoming John to the board. Returning as highly valuable roles at directors at large is Mark Collinson. Mark, say hello.
Good morning, everyone.
He is a founding partner of Compass Investor Relations, and he also works for the chapter in advocacy. And finally, also returning as a director at large is Craig Barberio. He is vice president of investor relations at First American Financial Corporation. The chapter is in excellent financial shape, and your board continues to strive to deliver top-tier programming, networking, and advocacy on behalf of the profession. In this COVID environment, we plan to use the virtual format to keep you informed and involved. And it's through our either monthly What's Brewing sessions, some special programming, our lunch and learns, and once possible, we hope to eventually have our networking happy hours. I just want to let you know, if you're not a member, I encourage you to join NIRI. If you are a member that is currently in transition, NIRI National and the Orange County chapter are waiving your fees for the year. So contact NIRI National membership for details if you are a member in transition. And now for the topic of the day, the proposed change in 13F filing. We will discuss the proposal, the implications, and what you can do to provide input to the FCC to stop the adoption of this audacious change. I want to thank Pat Tracey. Pat, can you wave? He's a chapter member, but he's out on the East Coast, and he helped recruit our guest speakers today from Morrow Sodali. They are a leading provider of strategic advice and shareholder services to corporate clients around the world. They're going to walk us through the proposal and how it can impact IROs and public companies in managing their shareholder population. I want to introduce Tom Margadonna. There's Tom. There he is. Tom is a director of capital market intelligence. He is a senior level executive with extensive knowledge of corporate transactions and over 25 years of experience in stock surveillance and market oversight. His professional background includes stints at Thomson Reuters, overseeing and managing corporate advisory team responsibility for providing consultation to 200 corporate clients. He was also at D.F. King, where he successfully launched and grew the shareholder management division. At Morrow Sodali, Tom is a senior leader in the Capital Markets Intelligence Group and responsible to ensure the highest level of corporate consulting, advisory for stock surveillance, investor relations, corporate governance, and shareholder activism. Second, also from the group, is Gerry Davis. Gerry, you want to wave? There he is.
Good morning. Good morning.
Gerry is Managing Director and Head of Capital Markets Intelligence, Strategic Stock Surveillance Group. He has over 28 years experience in stock surveillance, corporate actions, proxy, and bond-related matters. Gerry provides invaluable insight to his corporate clients, which range from small cap to mega cap and across all sectors. He has worked in numerous proxy contests, tender offers, and other corporate control matters. So I want to hand it over to Tom and Gerry to give us the overview on this whole change in the 13F filing proposal. Tom, you want to take it away?
Sure. Well, I'm going to attempt to share my screen right now. And let me know if that worked.
There it is.
Okay, great. All right, so we went through the introductions. So just overall, our goal for today is to provide some practical perspectives and share thoughts on how we see the potential impacts from the SEC proposed 13F rule. And as mentioned, we'll have some Q&A at the end of the discussion. So jumping right in, the summary of the proposed rule. This new proposed rule was a big surprise for most, if not all. There was no indication that this was coming, and especially concerning considering the push by corporations over the last several years to increase transparency around ownership. This would be a significant shift from how the system currently works. So basically, the reporting threshold for an investment manager is currently 100 million in equity assets. This proposal wants to increase that level to 3.5 billion in equity assets. No doubt a significant change. This new threshold, according to the SEC, would cover disclosure for greater than 90% of the dollar value of holdings currently reported, but relieving almost 90% of current filers that are smaller managers. However, this really does not address the main concerns over transparency, which we will go over today.
Yeah, and the 90%, when you put that in perspective, it's anywhere from 4,000 to 5,000 institutions. And we've done an analysis, and it'll affect anywhere from 5 to 10% of your profile, depending on your market cap.
Okay. Yep. So, why was the proposal put forth, and who benefits? So, as we understand it now so far, it is focused on smaller investment managers to assist with the burden of reporting and various costs. When we looked at this, it's hard to imagine that with today's technology and portfolio software, that the reporting process isn't much more than a few clicks for these smaller investment managers. Another concern is the possibility that some investors may copycat their portfolio investment ideas. However, this data currently comes out 45 days after the end of the quarter, so it seems less of a concern considering that time lag. So let's look at the other side of this. The main concern here is decreased transparency on ownership information. Every company will deal with what I call a black hole that basically gives no clear visibility on a portion of the shareholder base. And the real stinger here is that corporations have been pushing for the exact opposite, such as monthly reporting, the reduction in the 45-day time period following each quarter to 15 days, the disclosure of short positions. Right now, the only visibility we have is short interest data, which comes out bi-monthly and published by the exchanges. and then insight on derivative positions, which, by the way, are sometimes used by activist investors to accumulate a position through a prime broker. So basically, the proposal ignores the intent to require more disclosure from 13F filers, and the SEC did not seek the views of issuers before proposing this rule. And then also, by the way, I will mention that retail investors have also expressed concerns on having no access to institutional ownership or limited access, and that's evidenced by the comments seen on the SEC site. So just moving to the expected impacts, I think it's important to look at a few things. It's estimated that up to 90% of current 13F filers would not have to file under the new rule. It is also likely that corporations and IR teams would have less engagement and awareness of these smaller investors, which would ultimately lead to fewer meetings, roadshows, and targeting efforts, for example. Another area which will be impacted is the proxy voting process. It will be harder to forecast votes, solicit votes, and identify against votes with limited public ownership data. But I think the biggest risk of all here is the possibility that an activist investor could quietly accumulate a stake, and only after reaching the 5% level would it be publicly disclosed. This could essentially catch corporations and IR teams completely off guard.
Yeah, and that's a big point there, because you could have a wolf pack forming, 3 or 4 activist investors owning 3% under 3.5 billion in assets, accumulate in total maybe 10, 12% of the company, and you wouldn't know about it until someone actually files a 13D, or if you have a stock surveillance firm who's actually watching and looking at any accumulations going on. So that's a big point there, because a lot of major activist investors are under the 3.5 billion. Tom will go over it later, but Corvex, Starboard, they won't file anymore.
So the other important point that I wanted to make is that small, mid-cap, and micro-cap issuers will be impacted at a far greater rate than large-cap companies. And that's due to the ownership profile, which generally consists of higher proportion of investors below that $3.5 billion threshold. So, some studies estimate the impact range to be somewhere between 3% up to 23%, with about 15% on average. But it really just depends on the market cap. So taking a step further, we examined our database and some FactSet data. We looked at over 2,700 activist campaigns since 2010. Interesting, about 60% of the campaigns were driven by activists under the $3.5 billion threshold. Many were surprised to see some of the most dominant and well-recognized players in the activist world, as Gerry had mentioned, including some of the top names like Starboard, Carlson, Jana, Corvex, which is an offshoot of Carl Icahn, and Greenlight. I will also add, if anyone is interested in seeing a full list of the activists, we can provide that after the call upon request. So there's definitely some concerns. We should look at the impact of the ownership identification and how companies can identify shareholders. To be clear, there will be no big impact for the large passive index funds like BlackRock and Vanguard and State Street. The biggest concerns are really among the smaller investors. So relying on 13F data solely will be difficult. Many companies do utilize a stock surveillance firm to assist in the process, to help with things like Activist Watch and investor engagement, and to assist with proxy voting. Visibility will be reduced across the board on ownership and will present challenges for all, and that includes corporations and IR teams, as well as the service providers. That said, there are additional benefits to considering using stock surveillance to assist. So by tracking the daily trading activity and settlement in DTC, there is an early detection system in place that can alert for any large or unusual accumulations. So stock surveillance can provide good perspectives and valuable insight if the accumulation appears to be more of, say, a long-only type of firm, or a retail investor possibly, or if it looks more like a hedge fund. So finally, in terms of steps that can be taken, I think Ted will speak more about some of the specifics on this topic. However, I did want to mention and highlight some important points. As you consider the impacts and try to be proactive advising senior management and the board, you can work with your provider to review the current shareholder base, reference the equity assets for each investor, and then screen for any holders above and below that 3.5 billion mark. We are doing this currently for our clients, and it's helpful to gain perspectives on the number of holders above and below, as well as the percentage of outstanding. We'd also be happy to assist with that analysis if anyone is interested. After the call, we can help with that. So that's our overview that we had prepared for today. I'm sure there may be some questions. I will turn it over now, and hope everyone found this helpful.
Yeah,
Oh,
so
one point, just we're actually doing, as Tom mentioned, we're doing this for all our clients now. I just finished one yesterday for one of our mega caps. It only affected one institution in their top 100, but when you look at their lower holders, it affected 1,800 institutions. So it's a very big disparity between the larger and the smaller ones. For the mid to small cap, it's affecting anywhere from 20 to 30 institutions, or about 3 to 4%. So there's a wide range of disparity depending on your market cap and the institutions you have. We can help with that if anyone needs it.
So Tom and Gerry, thank you for the overview. What I want to do now is also joining us from NIRI National is Ted Allen. Ted is the VP of Communications and Member Engagement. Ted, along with our chapter member Mark, will touch on the NIRI National initiatives regarding the proposal and discuss ways the companies can provide input to the SEC. With that, I'm going to hand it over to Ted and Mark.
Well, I'll just step in to say really thank you to Ted for taking this time for us. Thank you, Ted, very, very, very much. Although I'm the chapter advocacy ambassador, I think this is probably one of the initiatives over the years that's attracted the most excitement. Perhaps excitement's one way to put it. And I think a lot of you are going to have questions about what other people are doing, what other chapters are doing, what other issuers are doing, which way the wind's blowing in terms of legislators, and therefore I thought it was really important to have Ted, who's the lightning rod for all the chapters, is the central point of contact for all of this, to be with us today, so you could find out on a national, not to say international basis, what's going on here. So. With that, I'll just introduce Ted, who I hope will give us certainly a summary and then answer your questions. A summary being, what should you be doing as an issuer, as a service provider? What should you be doing to get the SEC's attention here? Ted?
Great. Well, thank you very much for inviting me to participate in this in this webinar, this program. It's great to see the chapter stepping up to help get the word out to our members, across the country. In addition to NIRI OC, NIRI San Diego is planning to do a program next month. NIRI Philly has been emailing its members to encourage them to submit comment letters or to join a NIRI letter. And it's also great, and I appreciate the efforts of Morrow Sodali to participate in this webinar. We've been seeing a lot of interest from other service providers and other consultants to help companies identify the number of investors that they'll have, that would go dark under this proposal. So we really appreciate the help that the entire, IR community has been providing to companies so they can respond more effectively to this rulemaking by the SEC. I wanted to go over several of the ways that companies and IR counselors can help in this effort. The first thing you can do is to join a joint NIRI letter that we plan to submit to the SEC in mid-August. That letter is open to both counselors and to issuers. We already have close to 35 counselors and issuers on the letter so far. For the most part, they're small and mid-cap companies, although we do have a few large cap companies like Caterpillar and BP. And so that's, encouraging to see a wide cross-section of the membership join the letter so far. A copy of that letter can be found on the NIRI advocacy call to action page, or you're welcome to email me and I can send you a copy of that letter. All you really need to do is join that letter, is just send me an email saying your company agrees to join the letter, and we plan to list everybody at the end of the letter in alphabetical order, just to show the SEC that this issue is of broad importance to the wide range of public companies, not just small caps or mid caps, but to everybody and to a wide range of companies across the country. I've heard from small biotechs, I've heard from insurance companies, I've heard from the Edison Electric Institute, which represents electrical companies. So it's not just one industry that's concerned about this. It's pretty much everybody who uses 13F data, which is IR teams across the country. The next way you could help in this effort is to prepare your own issuer comment letter, and this is where the information that Morrow provides will be particularly helpful, because in these letters we are encouraging issuers to provide data as to the direct impact that this would have on their current 13F list, in terms of the number of investors in their top 100 who would go dark, or if there are any activists that are in the stock that you would no longer have visibility into. So the more data you can provide in these letters and talk about its direct impact on you, the more helpful it'll be and the more likely it'll get the attention of the SEC. Now, we have prepared an issuer letter template that I'll be posting later on today on the NIRI advocacy call to action page. So you can find it there. We also, as they come in, will be posting letters from other companies that have already submitted letters. I heard from a corporate governance consulting firm. They prepared a letter template, so I'll post that as well. So we're just trying to provide as many resources as we can to help companies navigate this process of preparing their own comment letter. And finally, another way you can help is through letters from chapters. And we're in the process of putting together a chapter letter template. Those chapter letters can be quite effective. We saw that in the proxy advisor rulemaking when we had 5 NIRI chapters submit their own letters to the SEC. And we thought it was helpful to show that these issues are a broad concern across the country, not just in Washington among trade organizations. I wanted to mention the timing of letters. The SEC, as of yesterday, had not yet posted the rule within the Federal Register, which starts the 60-day comment period clock. We expect they will do that either, if not today, then early next week. So that would mean that the 60 days would expire at the end of September or the first week of October, depending on when it's posted. So any letters that anyone's working on should go in before the end of September. All letters will get equal weight depending on when they're filed, presuming they make it in before the deadline. But if you're able to submit a letter earlier, and I know it's hard with a lot of people going through earnings now, I encourage you to do so, because the more letters that come in from issuers early on, it'll help encourage other issuers to share their views as well. One of the things that we've heard from issuers so far is they said, well, we don't see many other issuer letters posted already, and that's true. But I think what most people don't understand who are not within a company is that, companies are quite busy with earnings and other matters, and companies, it can often take some time to, navigate the internal hoops that you have, having your general counsel or your CFO look at the letter before you submit it. So we understand that, but we hopefully that you'll find these templates to be helpful. And we also prepared an FAQ document, about 7 to 8 pages, that provides information on the expected timing of this rulemaking if it were to proceed, and the chance that the SEC might withdraw this proposal, which we certainly hope they do. And we've been asking them for years to hold a roundtable on broader ownership transparency issues, including 13D disclosures, just to get the views from everybody, issuers, investors like pension funds who are more interested in engagement rather than trading strategies, but also to hear from the active traders as well, to see if we could reach some kind of modernization of 13F and 13D that would, still meet the needs of investors, but also, and issuers, but, address concerns about confidentiality and trading strategies. But as was mentioned on the call earlier, a lot of the argument about trading strategies doesn't really hold up, because with the 45-day delay in disclosure, most investors have already completed, whatever moves in and out of a company's stock that they were planning to do. So, we think that this rulemaking really has no basis in terms of the minimal benefits are far outweighed by the cost. And, we would appreciate any help from issuers and everyone else in the IRA community to help get that message across to the SEC. And hopefully they'll take heed of this input and withdraw this proposal.
So Ted, we're going to, from Orange County, once you have that chapter template, we have told Mark we want to go ahead and do that. And I got approval from my company and sent to Ted that Revance would be on the big company list coming from NIRI. So, and all of you, like he said, you just send him an email if your company approves being added to that list. Mark, you have any other comments on?
I want to just give everybody a chance to ask Ted questions. I've got a couple of comments really from the sort of small and micro cap side, which I'll make, but I want to give everybody a chance to ask Ted any questions they have.
And also Ted, Tom and Gerry also.
Of course.
So one question I had was, what do we honestly think is going to be the outcome?
Well, it's sort of hard to predict at this point. I mean, the SEC has in the past, withdrawn proposals, or proposals have become dormant when there's been, widespread opposition. In 1997, the SEC proposed to increase the resubmission thresholds for shareholder proposals. There was a big outcry from the governance community and from shareholder resolution proponents, and so the SEC withdrew that proposal. The SEC back in 2016 proposed a rule regarding universal proxy ballots, but that wasn't a priority for the new administration in 2017, so that proposal has been dormant since then. So that's our biggest hope, is that the SEC, and if there is a new SEC chair, which we think is highly likely regardless of who wins the November elections, we expect Jay Clayton to either go back to private practice. We as you probably have heard, he wants to be the U.S. attorney for the Southern District of New York. So that's a possibility as well. And of course, if Joe Biden were to win, there would be a new chair as well. So we're hoping that a new SEC chair will take a fresh look at this issue and will decide that this rulemaking, needs to be reworked. We would like for the SEC to, step back from this, take a more thoughtful approach and include provisions that would enhance transparency, such as reducing the 45-day period to 15 days or a shorter period, implementing the Dodd-Frank mandate that they propose a rule for short position disclosure by 13F filers, and also the final thing that we'd like to see is, of course, monthly disclosure of 13F positions, because as has been pointed out during NIRI's webinar, you're right now companies only really have visibility into their share base, 4 days a year when the 13Fs come out, and even that data is
old
is
by
out
the
of
time
date.
it comes out.
Exactly.
Yeah.
And the information that, that's the irony of all this is that the SEC has proposed to take away the information that's most valuable to companies, because if you're a larger company and you have a lot of, large, S&P 500 index holders, most of them are passive, and most of them, their positions don't change much from quarter to quarter. It's the active money folks under the 3.5 billion threshold that are the folks that companies, want to be watching for. So it's, the SEC makes a big to-do about, well, we want to increase the threshold to reflect the larger size of the market. But that's, of course, has been, inflated by, the very high valuations of a few very large tech mega cap companies. So we don't think that's the appropriate way of adjusting the threshold. And it's contrary to what the SEC has done in other matters, like the threshold for emerging growth companies. They use an inflation adjustment to address those thresholds. The threshold for companies that want to exit large accelerated filer status, they're right at the border where they can, that was raised recently, but only about 12 to 20% of an increase, not a 35 times increase is what the SEC is proposing. And even on shareholder proposals, there, which has got a lot of opposition from investors, that proposal, would increase the threshold from $2,000 to $25,000, but the SEC mitigates that by allowing anyone who's held shares for more than 3 years to continue to use the $2,000 threshold. But there's no such mitigation or any provisions in the SEC 13F proposal to, help companies maintain visibility into their shareholders. Like, for instance, one thing the SEC could have done is they could have provided for, those 13F filers who are exempted from disclosure to continue to provide information directly to companies where they have a significant stake, such as more than 0.5% ownership. And we think had the SEC tried to mitigate, it could have achieved the goal of reducing compliance burdens, which is rather modest, but also address companies' concerns about maintaining visibility into their most significant holders.
I mean, I think I would add, particularly from the sort of microcap, small microcap stake world, this is just a really bad thing. I mean, anybody who's an advisor to microcaps and witnesses the euphoria of finding the first 2 or 3 13F filers, you're going to take away from them that. You work very, very hard to get those people, on board. And you work very, very hard to engage with them. And also, as we know, one thing that may be missed here is the sectoral issue. There are some subsectors who will almost only exclusively have people who will go dark now. And so in the microcap space, you have these groups of sort of us girls, these bell cows who start to come into subsectors, and as a group, they may disappear entirely. And this is particularly true of, microcaps. So I think this is just a very bad thing for microcaps in particular, and I just wanted to draw out the sort of the subsector aspect of all this, which I think is pretty important.
Yeah, I had my surveillance firm take a look at who it would affect of my holders. And a couple of the interesting ones was some of my original VC investors fell below that level. So I would no longer be able to see how my original VC investors holdings were at. So that was a little annoying to me. And honestly, my top 100 holders, it didn't affect any of them besides those 2 VCs. It was really the smaller investors.
Right, and that's what I mentioned earlier. That's what we're doing with all our clients now, and it's the smaller investors, sometimes the ones who came in early, you're not going to have any disclosure on anymore.
Do you think that so a lot of the family offices would be below?
Well, some of them, Steve Cohen's will still have it because he has over 3.5 billion, but some of these smaller ones, there's no more disclosure.
Right. Wow. So do people have any other questions for Tom or Gerry? Any other questions on 13F? So the next thing I wanted to move on to was we've also got these new rules on the proxy advisory firms. Ted and Mark, you want to address that we just heard had gone through?
Ted, I'll just hand that straight over to you.
Sure. It's been quite a busy time at the SEC. I mean, as you heard last week, the SEC approved final rules on proxy advisors, and this has been, quite a long process and a long fight for these rules. This is something that NIRI's been working on for more than a decade. And it's something that, we've been working with closely with other corporate groups such as the Society for Corporate Governance. We'd also work with the U.S. Chamber of Commerce, BIO, which represents biotech industry, National Association of Manufacturers, and the Business Roundtable. So it's really been a broad effort. And the SEC finally approved new rules. Now, the rules don't go as far as we would have liked, and they're not as helpful as the SEC's original proposed rule they unveiled last November. But they still give issuers probably about, 75% of what they would hope to get. And it's certainly a big improvement over the status quo. I think the most significant provision is the fact that all issuers will now be able to attain a copy of the proxy advisor's report as soon as it is issued to investors, or perhaps even before, if the proxy advisor opts to do that. In the past, micro caps, small caps, anyone outside the S&P 500 has been excluded from, getting ISS reports prior to publication, and Glass Lewis charged everybody for access to its research. And they've been modifying their practices and trying to provide more openness, but still, it's Glass Lewis was pretty much you had to pay something to have access to their research, and so that's good to see. We would have preferred that the SEC mandated a 5-day review period prior to publication and prior to when investors start to vote, so issuers would have time to review the draft reports and to submit comments or rebuttal. Often with the proxy advisor reports, it may not be a factual inaccuracy that's in the reports, but it may be a misunderstanding about the company's business, or the proxy advisor may be using a certain one-size-fits-all model to assess your compensation that's not appropriate for your company, or the peer group may be wrong for your company. So we see it as very helpful that the SEC is sort of enshrined into its rules a process for feedback. And the other key part of that is that the proxy advisors are supposed to alert their investors when an issuer has filed a response to a proxy advisor's report, or indicates that it's planning to file a response. So hopefully that will cause many of these proxy firm clients to hold off on voting until they see the corporate response. Related to voting, another important thing that the SEC did, they issued new guidance to investment managers that hire proxy advisors related to their voting responsibilities and their use of automated proxy voting systems. One of the things that we learned back in 2017 is that there's a growing number of investment managers. Most of them are small and mid-size, or they're quant-oriented investment managers. They don't really care much about governance, but who have essentially outsourced their voting to proxy advisors and use these automated systems, which would essentially allow you to set your preferences before proxy season, and then forget about it, and knowing that your votes would be all cast. But of course, if you do that, you don't see the corporate, any corporate response to the proxy advisor's reports, and it's something where you're essentially just outsourcing your fiduciary duty to your beneficiaries to a proxy advisor. And, we thought that was very troubling. We raised that concern with the SEC in 2017, and we're glad to see that the guidance at least addresses that in part. And, we hope that investment managers will be more thoughtful about using these systems and will, take action if there is a corporate response to at least read it. And then if they decide to vote with a proxy advisor, that's fine. But, we want them to at least do the minimal effort of reading the views of companies, because, companies work very hard on their disclosures and their responses to proxy advisor reports. And in the past, a lot of that's been ignored by, investors either robo-voting or, only reading the proxy advisor's report and not the actual proxy materials themselves. So we're encouraged by this. Many of these changes that impact the proxy advisors won't take effect until December of 2021. So you won't see any immediate help during the 2021 proxy season, but the guidance for investment managers does take effect earlier. So you may see a decrease in robo-voting. So we're hopeful that, over the next 2 or 3 proxy seasons, that companies will see an improvement in the process, and at least will have a better sense that their views are being considered by investors before they vote, as compared to now, where really it's only the S&P 500 that, gets to present their side of the story and have that considered.
Yeah, I used to have to try and get it from my law firm would get their hands on it for me so I could see it. But, it always just kind of hits you out of the blue. And this is great that we can finally have access to our reports.
Yeah, I was wondering if this has implications for the logistics of the proxy season for issuers. I didn't know whether any of you on the call were thinking, well, there's now something we can do in terms of a calendar, given that we're going to get to see these reports when we're going to get to see them. It sounds like you're going to have to respond in a pretty timely basis to them. And therefore, are there things you should be doing internally now to be ready as soon as those things hit? And we had thought as a chapter that we might have a future meeting on the logistics of proxy season. So
yeah, because in fact, David, I don't know if you can talk, David Erickson, is, there were certain situations where his company knew in advance they were going to have issues, and they may have Glass Lewis and they may have ISS going against them. So, they did very proactive outreach in advance of all of that. But sometimes you just don't know. You get hit by surprise that Glass Lewis suddenly says, we're not gonna vote. You'll tell our firms to vote for certain one of your board members because they had voted on something else a year or 2 earlier. And sometimes that comes as a surprise. David, you want to comment?
Yeah, I mean, on certain issues, you already kind of know which way Glass Lewis and ISS are going to lean because they've previously stated their positions on things. And so if it's one of those, you don't really need to wait for your report to come out. If it's something, and my big issue with the reporting is the errors that are very often included in those reports. And if they get issued and people are voting and taking action on erroneous information, that's a big problem. And then some of the issues that, we were, assuming might be down to the wire for getting enough votes, if they're already voting one way, because of misinformation, then that becomes problematic. So I think just the increased visibility, the proposed lead time that more companies will get with regard to those reports, and the ability to comment and make those comments more broadly available, I think will be beneficial for all.
And Tom and Gerry, your companies actually help people in some of the outreach, is that correct, on proxy issues?
Yes, yes. We have a corporate governance group, and that's what they do. It's a year-round service, and that's what they're doing
What's
throughout
the
the year.
biggest issue that they have to work on?
Not really sure. I'd have to talk to Bill Oltan, who's the head of that department, and see what the issues are. Obviously, all the ESGs,
Yeah.
those are always big issues. And I know
Say
now
on-
they're
say on
still,
pay.
yeah, there's exactly
Yeah.
say on pay and overboarding. So they're working on all those and working on recaps over the summer.
Great.
Yeah, and I would assume
Jeannie,
boards are- Go ahead, Pat.
I was going to say that I've talked to Bill, who was mentioned Bill Oltan about this, and and companies that have if they pass their say on pay vote but have a high percentage against, that's something that activists can look at, because if they're looking for a future campaign and they see a bunch of people voted against the say on pay issue, like that they might see people they can convince to vote along with them. So it's something that. I think the say on pay issue, it's an underrated issue. I mean, it's not like like it was 4 years ago, but it's something that people do look at. And so I think it's always, executive comp issues are always going to be a big issue, that have to, because you kind of, I know in the past, I worked with clients that hired ISS to, help them create the comp program, and then issued a recommendation against it, even though they'd hired them to do that. So
Oh my God,
it's something
really?
that I always think that ISS is something, that excuse me, the exec comp issues are always, front and center, and then I guess the thing that, I would suggest also would be ESG issues on a going forward basis are going to be something that, you kind of have to figure out the lay of the land there. And I think it's also where, they've beaten the snot out of all the Fortune 100 companies over the years. So it's going down market to mid-cap companies and small cap companies. That's kind of the way these things work. So if, I would say for smaller and mid-cap companies that, I think some of the issues, like the easy ones, like plurality voting or something like that, or staggered boards, are work their way, all the way down towards smaller cap companies. But these are types of issues that, I think the NIRI Orange County folks ought to, take a look at, and that's what I'd be concerned about.
Hey, Tom and Gerry, I had somebody ask if you could send us a copy of the presentation, and I'll send it out to everyone that was on the invite, if you could do that. Right.
No problem. We'll send it out right now.
Okay. So any other comments or questions on the 13F or the proxy issue? No?
Yeah, I had a question on the 13F. So I was just wondering, in terms of the timeline that was laid out earlier, if that's purely at the SEC's discretion, or is there anything in terms of kind of anyone putting in a lawsuit or something like that that could impact the timeline?
The timeline is pretty much up to the SEC until the, in terms of getting to a final rule process. There's no way to block it before they propose a final rule. We expect, if they were to take their normal approach to this rulemaking, then the rule could be finalized in February or March of 2021. But there's at least a small chance that Commissioner Clayton may try to expedite this before he leaves the SEC. And we expect he'll leave the SEC regardless of who wins the election by mid-January. So there's a remote chance it could happen before then. We're hoping that, given the volume of retail investor comments against this and the volume of issuer letters that we hope to see, that the SEC, that will slow down the process, because what they normally do is they hire an external research firm to help digest all the comment letters. And if there's only 20 comment letters, that's a quick process. If there's 1,000 comment letters, that should hopefully take more time. And time is on our side in terms of trying to defeat this. So we hope that the volume of opposition will prompt them never to get to the final rule stage. If they get to that stage, then that's where a potential lawsuit could come in. And usually in these cases, lawsuits are brought by, say, an issuer who would be impacted, and in conjunction with a trade association representing the views of other issuers as well. So hopefully it doesn't come to that, but we think from a legal standpoint, this rulemaking is on very flimsy ground. Even Commissioner Allison Lee made that point in her dissenting statement when she talked about how the SEC really doesn't have the authority to make such a dramatic change in 13F disclosure thresholds. We agree that the SEC has the authority to move up the reporting period from 45 days to a shorter period, but they really don't have the authority to expand the threshold by 35 times. The SEC claims it has exemptive authority to do this, and they've used this exemptive authority during the pandemic to give companies more time to make disclosures, which was helpful. And we think exemptive authority is great for situations like that where there's a crisis. But if you're implementing a significant rule change that's not temporary in nature, we don't believe the SEC has the authority to do that. So that certainly would be a key point in any sort of lawsuits. If there was a lawsuit, certainly whoever was filing that lawsuit would ask the judge to block the SEC from implementing the rule or until the lawsuit was resolved. And that happens in other cases, such as the exchanges suing the SEC over the transaction fee pilot program. So that's fairly common. So that would be our biggest hope, is that if this were to be finalized, that a lawsuit could at least delay the impact of it for another year or so.
Yeah, I agree with Ted, because this clearly, the rule back in 1975, Congress created this rule, and the intent was for more disclosure. And obviously what's going on now is less disclosure. And obviously with Allison Lee against it, I think there'll be major problems with this. And I'm not sure what's going to happen, but there may be a compromise of maybe 5 times or 10 times, 500 million or $1 billion. We'll see where we are in September on that.
And also, if you look at the comment letters from just ordinary people, retail investors absolutely hate this. I mean, I think I must have read about 100 of them, and there are only 2 came out in favor of it. They absolutely hate this. A number of them said they trade on this idea of what they call over-invested stocks. So they buy things in which there's not a 13F filer.
Well, that's what's going on now with Robinhood. Robinhood Securities, they're going crazy right now. If you looked at Kodak the past 3 days, Kodak was trading at $3, and all of a sudden there's a story coming out. It went up to $50 in 2 days, and it's down to $28. And I'm 90% sure a lot of that was retail Robinhood investors pumping up the stock. And now I think it's down 10% today, down to 25. So someone made a lot of money, but I'm sure someone who bought at 50 lost their shirt because it's down about 50%.
Right. But to the extent that any of the sort of stock market attributes were all about the access, the transparency that favors small investors, that this is a way for everybody to own a piece of corporate America, we're definitely going 10 steps backwards here from what I can see from the way retail investors are looking at this. So
I agree.
And as far as the companies go, if this goes through, definitely more investment into surveillance is going to be required. So more expenditures on the part of the company. I don't know if using that as a little bit of a twist in there as well. It's really going to cost a lot more.
That's what we're doing now, because right now we know where all the major holders are. Vanguard, T. Rowe Price, FMR. We know where they hold. Your smaller investors, what we're doing now is trying to do a matrix to find out where they hold. So if this does go through, we could follow their custodial positions. If they don't disclose anymore, we could still let you know what their positions are.
So that's going back to old school reporting,
exactly. I've been doing this 30 years. This is the Coachon days where you're looking at 13Fs when they first came out, and it's just a different time.
Mm-hmm. Okay, well, any last minute questions anyone have on these topics?
Well, one point I wanted to make, and I don't know if there's an active IPO market in your area. But, we also think this rulemaking could chill that market as well, because if you're a private company and you have a lot of, early stage, VC investors, everybody who's in your stock. And once you go public, you lose a lot of that visibility into who owns your stock. And then you're exposed to, short and distort tactics. You're exposed to activist investors. And, if you're a private company CEO, this is going to be one more thing that weighs against going public, in addition to all the, SEC compliance costs that you have to face, the proxy advisors. So we think this is really unfortunate from that standpoint. And, from a future of creating more public companies and more IR jobs, it certainly is going in the wrong direction.
And I think I heard you make on a previous call, Ted, the point that those companies that do go public are going to be increasingly reluctant to release voting power to people.
That's right.
The people they don't know who they are.
Yeah. Yeah.
Right, exactly. And if you're going public, you're going to be much more likely to follow the advice of, some of the law firms in Silicon Valley and, adopt a dual class share structure or 3 classes, which is something that the public pension funds and the governance community just they hate that.
They hate that, and they vote against people that put it in. And yeah.
Exactly. CII, which, the Council of Institutional Investors, they've been trying to pressure the exchanges to force companies to sunset dual class structures. But, I think that's a good point. I mean, I think a lot of companies are going to respond by adopting dual class structures. Many companies have put poison pills back in place, particularly during the pandemic, because they were concerned about the threat of activists in a post-pandemic environment who were able to buy up shares of the company relatively cheaply. So we're just going to see a lot less engagement, less accountability to shareholders because of this loss of transparency. So I think it hurts both large investors, small retail investors, and companies. The only beneficiaries are a relatively small group of hedge funds, as far as we can tell.
Great. Listen, I want to thank you, Ted, for getting on from NIRI National. Tom and Gerry, and also Pat, thank you so much for giving us the advice from your firm. I just want to do a short little promo. In August, our What's Brewing is going to be on IR tools, and we will have a small group from Virtua to talk about what their offering is, and then we'll have a more expanded discussion on what we're using for IR tools and what we'd like from IR tools. Then in September, Mark has already got Professor Schwartz from UCI, who's an economist, who's going to get on and talk about the economy and what maybe the election's effect may have on the economy. So that's going to be a very lively discussion in September. So I hope you all enjoy us then. Yes, Mark?
Yes, come back and be with us, certainly, for both of those. And the Economist, he's a very good value, quite funny. So we're looking forward to seeing you again in August and September.
All right.
Okay.
Great. All right. Thank you so much for joining us, guys.
Thank you, everyone.
Thank you. Bye-bye.
Have a good weekend.
You too. Bye-bye.